Central Bank of Sri Lanka is it's a apex financial institution in this country, which has been established in 1950. In fact, the work related to establishment started in July 1948, just few months after Sri Lanka came to independence. You may have observed that during the last 10 years or so, after 2008, we saw Sri Lanka Army celebrating anniversaries, Sri Lanka Navy celebrating anniversaries, Sri Lanka Air Force celebrating anniversaries. All these institutions celebrating their 50th anniversary close to 60th anniversary close to and now they are celebrating their 70th anniversary. Trying to draw a parallel here, like Army, Navy, Air Force are kind of national symbols of the sovereign state. Central bank is supposed to be one like that. That is why central bank was established just after getting independence. To be a country with independence, there should be a central bank. That would have been the thinking at that time. So with that hope, the then finance minister, Mr. Jayawarman, invited. It would have been very normal for government of Sri Lanka to turn to the government of the United Kingdom and ask the assistance. But that's not what happened. The then finance minister wanted the government of the US to come and help us. That is how the first Sri Lankan government, first governor of Sri Lanka, was a US national. He came here and started working with the assistance of people like this, Justice Chief Fernando, to establish the Central Bank of Sri Lanka. The central bank has the authority and is responsible for administrating, supervision, regulation of monetary, financial, and payment systems of the country. Statutorily, we have been mandated to do these things. And it will be to encouraging and promoting the development of the productive resources of Sri Lanka. Central bank is restricted to main objectives. Earlier, we had multiple objectives from 1949 to 2002 or so. Now we are confined to two main objectives: maintaining economic and life stability and maintaining financial system stability. Now these are the two specific objectives the central bank is supposed to achieve. Sometimes there are a lot more expectations from the country than these two, but these are the statutory objectives. You know that as lawyers. Statutory body cannot step out of the statutory mandate to it and do whatever it feels like good. But these are the statutory objectives given back to the central bank. There are certain other statutes which have given certain kind of enlarged scope to the central bank. This is the specific central bank objective. One price stability, which may not be very relevant to this audience, I'll run into the other part which is more relevant to you. Price stability is generally maintaining general price level of consumer goods at low and stable prices, and general price level captures the overall impact of individual price movements. So, when we talk about inflation and things like that, those are covered in this first objective of the central bank. General price level is measured by price index, which is weighted average price of a basket of selected goods and services, of which lawyers may not be very much interested, but these are the price stability related to weights represent relative importance of each item in somebody's consumption pattern. And what is more important to this audience is the central bank's second objective, which is financial system stability. When you look at financial system stability, it's very difficult to define what financial system stability is. There are a lot of arguments all over the world as to what financial stability means. But there is no particular agreement as to what financial stability is. But I really like one particular kind of, I can't call it a definition, description given by a colleague in IMF. He says financial system stability is the absence of financial system instability. Right? It's not something very palatable to lawyers to say that something is other side of the other thing. But it makes sense in the sense when there is a financial system stability in the country, nobody feels. No one thanks the central bank here or in other country for doing a good job in maintaining financial system. But moment to see that there's a tiny finance company is having a problem, everybody start blaming the central bank, look here, you are not doing anything. That is the blame coming. So it's in a way understandable to say that financial system stability is the absence of instability. Now, having said that, let alone financial system stability, what is financial system? This is something technical in a way. Now, when we say financial system, we basically consider financial system to include the 3 or 4 basic components. One is there are financial institutions operating in the financial system. In our economy, for example, we get licensed commercial banks, licensed specialized banks, then finance companies, leasing companies, property insurance companies, mutual funds, unit trusts, superannuation funds like EPF and ETF. All these are financial institutions in an economy. Now, these institutions are players. They can't interact without a suitable ground to play. There should be playgrounds provided for these players. Those are the financial markets, which are again identified in this slide. Financial markets are the places where financial institutions interact with each other. Now, this interaction cannot be an interaction proper unless they are provided with necessary instruments to interact. That is why shares are there, that is why debentures are there, that is why insurance policies are there, that is why checks are there, promissory notes are there. You see, all these are financial instruments. Now you get players, playgrounds, and necessary instruments for this game to go on. But with players, markets, and instruments, there will be some sort of an unclear position. Unless they are properly managed by proper infrastructure, it will be very hard to have a proper game going on. Now, I took this example with some of my colleagues here when they joined Central Bank. Institutions are like players. Just because Sri Lankan team is in England now, and Afghanistan team may be staying in another hotel, just because 2 teams are staying in 2 different hotels, there is no game. They need to come to a ground, Cardiff or anywhere. They should come to the ground. Players on the playground, they should be provided with necessary instruments. Without bats and balls, there is no game. But even though everything is provided, unless there are proper rules, it will fail. You all know that it will fail. Now, what it fails? How do we determine the result? Dr. St. Louis would be a method. That should be some framework of rules and regulations to deal. Without all these things, the financial system is not going to work out. System is not going to work out. So that is what is meant by financial system. Now, to maintain stability in all these areas, in institutions, markets, instruments, as well as infrastructure, like payment and settlement systems, legal infrastructure. Without legal infrastructure, financial system stability is not possible. Now, so to achieve financial system stability, we see the need to look at all these components of the financial system. And to do that, the central bank is vested with several powers coming from monetary law, then the Banking Act, Finance Business Act, Leasing Act, Foreign Exchange Act, Payment and Settlement Act. So, now these five basically certain powers for the central bank to issue directions for the achievement of objectives of these statutes. You see that there is a wide range of things. Monetary Act deals with the establishment of the central bank and the monetary system. Banking Act with banks, licensed commercial banks and specialized banks. Finance companies are covered by Finance Leases Act. Leasing companies are covered by Leasing Act. Likewise, there are statutories. Now, this is the economy. This is the legal economy in which central bank would operate. My colleagues suggested me that words are very much things like that. AWPLR, what do you mean by this kind of thing? Now, these sorts of things are probably nominated with the central bank taxes. Now, these are how interest rates are defined in an economy. Central bank collects data and look at the interest rates against which loans are given. Then those loans are weighted according to the amount or the volume of the loans, and looking at taking it as the numerator and denominator being total value of loans, we calculate something called average weighted prime lending rate. What is the average lending rate bank would be operate to a prime customer? Now, this is not something central bank prescribes. It is something central bank would calculate based on the actual workings in the economy. So when this is required, probably a customer would obtain a loan from a bank, setting this interest rate, agreeing this interest rate with the bank, having this as a benchmark. AWPLR plus 2% or something like would be that. AWPLR is not determined by the, determined by the central bank, but it is calculated. So, central bank does not have an effective role there in controlling the rate. But as a role, it letting you know what is going on the economy. Because in the pre-economy, banks are there to determine the rate. If someone is outlier, say if a particular bank is offering large, very high interest rates for deposits, you would not go to other banks. You would go to that bank. So, trying to concerned about the stability asset. Take the other side, if a particular bank is offering loans at a very high interest rate, you would certainly not go there. You will go to other banks which are giving you loans at much comfortable rate. So that protection for the customers is inbuilt. But to avoid prevent misuse of the things, central bank would implement certain incentives. Similarly, Sri Lanka international rate, SLIBO, for international transactions, SLIBO, and things like that are categorized. Now I can go to some areas pertaining to traditional bank customer relationship and come back to the modern environment in Sri Lanka today and to relate that traditional position to present position. Probably most of you are aware that the bank customer relationship in English law is defined as a contractual relationship between these two parties. It's not a continuous, it's contract, where the relationship between the bank and the customer is supposed to be akin to or similar to the relationship between a debtor and a creditor. The bank is a debtor and the customer is a creditor. Why? Customer is a person who keeps his money with the bank, and bank agrees to give that money back when the customer demands. So customer is the creditor and bank is the debtor. Bank has basically borrowed your funds and kept in their custody. The principle in law, as very clearly given in very old English judgments like Polly versus Field, is that when a customer deposits his money in parcel doors, that money becomes bank's money. The customer's money, whenever handed over to the teller in a bank, it becomes bank's money. Bank can use that money, even that Tottenham's judgment in Polly versus Field goes on to say that even if the bank puts the money into jeopardy, even then, that's bank's money and customer has no case. But there are statutory developments which would ensure that customers are not put into danger like that. But traditional common law principle is that when the money is given to the bank, it it's bank. Bank can do whatever it wants. But if you leave a bank like that, we don't know what will happen at this point. So we want to tell them, look here, if you take customers deposit, you need to keep this kind of capital with you, otherwise you are not allowed to do business. If you got customers' money, this is how you can lend. You can't lend to a related party more than this. You can't lend to a particular situation like this. There are a lot of controls coming from the regulator because common law is that bank is using bank. Now we intervene and say, look here, you can't do this particular transaction. Unless you increase your capital to this level, you cannot be lending anymore. Likewise, central bank intervenes and tries to kind of strike kind of a delicate balance between common proposition and the desired position in an environment where customers are the more vulnerable people. Like a bank customer compared to the bank is a very weak person. So the regulator's role there is to ensure, using the statutory law and the other instruments available to the regulator, to ensure that this traditional concept would not penalize the customer for keeping his money with the bank. Now here I would like to tell you that banking is sometimes referred to as banking and finance, but finance intermediation. What do we call it intermediation? Intermediation is that you are the intermediator, you connect two or more different parties. Now in banking, what happens is you take money from depositors on one hand and take the pool of resources in the bank and lend that money to certain other set of people. Now if you look at the environment in which this happens, you would be surprised why banks are still surviving. Now you collect money from people. Who are these people? People like salaried employees. Those who are getting a salary of 50,000, they would save 5,000 out of their salary. Some clerk working somewhere. These people somehow save some money and deposit. And from, as I said, now this money is a pool in the bank. The bank give away loans using this money. Now look at these two things. The basic and the largest asset of a bank is the borrowers, loans and advances bank has given. That is the largest asset in the bank's balance sheet. What is the largest liability in bank's balance sheet? That is deposits. You have collected deposits. That's your liability. You have to pay it back. Your asset is what you can recover, what you have lent to the customers, borrowers. Now just look at these two assets and liabilities. Two largest the largest asset and the largest liability. This largest asset is long-term in nature. So you give away a housing loan, which is supposed to be recovered in 20 years' time. But your deposit is not like that. A customer may have opened a fixed deposit with you, a banker, yesterday, to keep that money for 5 years. But if today comes in and says, okay, I'm in an emergency, I want that money. You can't. Now what has happened to that money? You have given away that money by a 20-year loan to someone. Now you can't tell the customer, depositor, look here, we have given away a loan, you need to wait for another 20 years so that you can recover the loan and give it to you. No, customers are not going to wait like that. Now if this continues, if the bank is compelled to say, look here, we don't have money today, why don't you come tomorrow or something like that? You know what happens? You have practical example what happened to a particular big commercial bank in 2008. You can't tell a customer, come tomorrow. Customers are there to take money now. But your loans are not like that. You can't refer them for a very long period of time. So this is a very fragile business. I'll tell you, to put it simply, if all the customers of a bank comes and ask for their deposit at a one particular time, any bank anywhere in the world will collapse. That is a given. So you need to regulate the system in such a way that customers will not come at a particular time and ask for more. That is the time. Which is not an easy task. Which is not a, which is basically a thankless job to do. So in doing that, I told you that bank traditional idea is that bank is the taker and customer is the seller. Right? Now, additional data-based relationship with some modifications applied to it. Now, when you look at the data-based relationship, probably the position in Norman Dutch law and position in English law would be different. In banking, but the general law applies in banking is English law, but English law principle related to data and technical relationship would not apply to the bank customer relationship in the same way, but the exceptional situations would apply there. I don't want to go into that or let me that. And the bank works in several different capacities. I have put here three more things: agent and principal. Customer works as a principal and bank acts as an agent. Now, when you draw a check on your bank, what do you do? What do you tell them? Pay 1 million rupees to so and so. Right? You give them an order. Bill of exchange, a check is an order, unconditional order given by the customer. Right? So, to whom you get your orders? To your agent, because you are the principal, you are giving orders to the bank. So, bank is not only debtor credit not only the debtor, it's an agent in certain instances. When it comes to the subject that we are going to cover today, here, then maybe it is a mortgagee, where the customer is a mortgagor. There are certain instances where even bank can act as a trustee for the benefit of the customer in exceptional circumstances. So there are different roles played by a bank. Whatever that role is, customers are not interested in that. They want to ensure that their money is safe. Right? So, the role is much more dynamic. And to ensure customer protection, Banking Act Direction number 8 of 2011 issued under Section 46 and 76A of the Bank requires the bank to have customer charters, including provisions pertaining to certain aspects of their relationship with the customer. I have given in bullet points several areas that are supposed to be covered by the customer charter. So when a customer charter is prepared, a customer who is having a problem with the bank should be in a position to seek relief in terms of the customer charter. Now there are a lot of mechanisms. Finally, one might come to the court. But before that, customer charter would be a very good base for the customer to seek relief. And my brief presentation would not be complete unless I mention something about financial intelligence unit. As I said, financial intelligence unit was established in 2006 under the Financial Transaction Reporting Act, and it's supposed to objective is to combat operations pertaining to money laundering and terrorist finance. Sri Lanka was in a very long process of enacting anti-money laundering related laws. This is one of the first assignments given to me when I got into that in 2000. It took several years to finalize the law. Now, in 2006, now 2006, that is the Prevention of Money Laundering Act. In Section 3, it defines offense money laundering, and then there are presumptions of you see the number one here, that is the Convention on Suppression of Terrorist Finance Act, which was enacted in 2005. These two things would provide for terrorist financing and money laundering, respectively. What is the third statute? Third statute is the procedural thing. That is the overall statute that would ensure that the country ensures the implementation of AML and CFT, that is anti-money laundering and combating financial terrorism law. For that, financial intelligence has been established. You may be aware that banks are supposed to report all their transactions above 1 million rupees. What does that mean? That doesn't mean that all transactions above 1 million rupees are something, that there's something wrong with that. No, it's not the case. When you report that kind of thing, a financial intelligence unit is in a position to process that data and see whether there are patterns and see whether there are undesirable things going on in the financial system. And then you see that there are certain provisions in the financial transactions reporting act, especially in section 7, related to suspicious transactions reporting. Banks are required to report whether a particular customer is kind of doing suspicious transactions. There are guidelines on KYC and CDD. KYC meaning know your customer, CDD meaning customer due diligence. Now, banks are supposed to comply with these guidelines and report suspicious transactions to the financial intelligence unit. That is again to ensure health in the financial system. If the country's financial system is vulnerable to large-scale money laundering and terrorist financing, surely that country cannot survive in the global economy. To ensure that this kind of mechanism is also helpful, that is why it has been with the central bank. If you look at these statutes, there is more mention about the central bank. Financial Transaction Reporting Act allows any government department, public corporation, or something like that to be the authority responsible for this. Now, it has been given to the central bank for this reason that it has something to do with financial stability as well. Otherwise, it's not really a central bank job to do financial stability. It may be the job of the policy bank or enforcement authority, not really the central bank. But in Sri Lanka, like in several other countries, it has been given to the central bank as well. That is what I just wanted to mention the short period of time available to me. I think this is not what you expected from this seminar, but I gave you some sort of an opening as to the limited role played by the central bank in this area. So based on that, I will say that I will get to continue with a good discussion.